Hey, everybody, welcome to Under the Hood. Today on the show, we're talking about how humility and diversification are connected, how picking alternatives can feel like March Madness, and the fact that relationships are always the focus. And we'll be talking about that with Brandon Fink. Brandon, you ready?
I'm ready.
Let's do it. Hey, everybody, welcome to another episode of the Under the Hood podcast, hosted by Stallion Capital. This is your co host, Tim Douglas. And today on the show, we have Brandon Fink with Claro Advisors. Brandon, how you doing?
Good. How you doing?
I am doing fantastic. Thanks so much for asking. And we like to jump right in, always starting with hearing your story. So if you could tell us a little bit about your journey into the financial space and your firm, that'd be great.
Absolutely. My journey began in 2012, from the early days of putting 50,000 miles on my car every year because I was visiting people at their homes from about 6 a.m. to 9 o'clock at night, Monday through Saturday. Just grinded to the point where 13 or so years later, I've built relationships all over the country. And I can now dedicate most of my time, most of my day to helping my clients realize their goals. Today at Claro Advisors and with my client base, my clients span from individuals with a lot going on, vast wealth and financial complexity, to the families that have a bit less complexity. But, as I always say, I made promises early in my career that I would take care of all of my clients, and I'm not one to break promises.
I love that. And so back in the early days, you said you were house to house, 50,000 miles on the car from 6 a.m. to 9 p.m. Were you booking appointments for a week and then showing up to those appointments for a week, or how did that kind of process work?
I would see anyone willing to see me, when I was 21, 22 years of age. And, I look at that as my training, my interpersonal training, not so much about what was going on in the markets, not so much about tax and estate planning strategies. It was about learning to understand people, understanding how to have deep conversations, understanding what was important to people and how to understand, what separated one family from another. Uh, and I look back on it, I couldn't have asked for better training to what my practice looks like today.
With that understanding, was it like you had some natural intuition? Did something in childhood prepare you for that? Or was it a book like How to Win Friends and Influence People that gave you your start?
You'd have to go back to, yeah, I made a conscious decision to become a wealth manager when I was about 20 years of age. And, like any young person, I had pipe dreams and, wanted to be a pro athlete and then wanted to coach and wanted to be in the music industry and, wanted to do a number of things. But one of the things I learned very early on was that I wanted a career where I had a natural skill set. And I knew that I had a natural skill set explaining finance to people. I was always the kid in the undergraduate finance classes. I would never necessarily get an A+ on the test, but people would ask me to tutor them and they would do better than I did. So I had this innate ability to teach, to listen, to break down complex topics and make them quite simple. And I wanted to find a career where I could do that each and every day. And I stumbled upon wealth management where, as we may talk about today, people think it's a numbers business, but it's a people business. And my innate desire and ability to deal with human beings really was what allowed me to love this profession and do well at it at the same time.
Yeah, no, that's really cool. We are going to talk a little bit about the numbers side of it with, current market insights, alternative market insights, but I suspect that woven through all of that will be the people side of the business. The fact that people invest emotionally and that these are people's kind of generational wealth plans, their estate plans, their retirement plans that you're dealing with. And so not only is it the money aspect, but it's a lot of the dreams and goals. So I love that not only are you focused on the people, but also you've made promises from early in your career that you're still holding to this day.
Always.
That's a really admirable thing. And so, talk to us a little bit about the stewardship of these relationships, both from a just pure relational aspect, the understanding side of it, but then also where you're going to kind of stay up to date with the latest market trends. So, you're always bringing your clients the best information.
when it comes to everything that's going on in the world, and I say world instead of market because what it's really about is understanding the world and understanding history and understanding culture. And yes, personal finance and markets is part of that. To me, it's all about listening and speaking to individuals that are smarter than me. And I tell my clients all the time, I'm not the smartest person in the room. If you want to hire the smartest person in the room, don't hire me. I'm about listening, finding people that have unique perspectives, and asking really good questions. It's what I'm reading, it's what I'm listening to, it's what I'm studying, it's even what I'm watching on TV. Where can I pick up a unique understanding, a unique insight that's going to be valuable? It's going to be valuable personally and professionally.
Yeah, no, absolutely. And so when you're talking about people smarter than you, are there specific minds that you listen to? Or are you just always open to recommendations?
I'm always open. I've got the go to. I'll read something in the Wall Street Journal. Um, and it will quickly dawn on me that I don't understand the full picture. I don't understand the origin. Yeah, I'll look at things on Wikipedia, right? And at times I deliberately listen to people that I don't agree with.
Mhm.
And I think that's where a real sense of empathy comes because, it's the understanding that the world is more complex than people even realize, right? But understanding these different perspectives, understanding these different mindsets, and having a respect for history and, you know, whether it be markets, whether it be history, whether it be culture, whether it be art, what's the origin? Where did it come from? And understanding that across different lenses, the one commonality is we're all dealing with people. So, yes, my friend, you are right. It's going back to the understanding of people. Within all of these issues, market related or not, the one common factor until AI takes everything over is we're dealing with human beings.
Listening to people you don't even agree with, seeking to understand history, are you using that information to inform just your relations with your clients or also your understanding of the market?
Both, absolutely both. And, I'm able to understand my client's perspective. I don't agree with all of my clients. That's okay. That's the beauty of it. We still form a beautiful synergy together. But whether it be markets, whether it be the emotional side of my clients, it's aided in helping me understand both
Hmm.
with a unique lens and a unique perspective.
Talk to us a little bit about the current market, and maybe you can put it into a historical frame if you would like, but what factors should we really be paying attention to today? And then what's your high level strategy to address them?
Well, first and foremost, I try to pay more attention to the factors that dictate the lives of my clients, what's going on in their world each and every day, because it's typically and often not directly market related. When it comes to the markets, I think of humility and I think of diversification because much of what will drive the markets the next 10 years, we do not yet know.
Hmm.
People were not paying attention to subprime mortgages in 2005. People paid too much attention to federal deficits in 2011. We weren't talking about a pandemic in 2019. And during the height of the pandemic, we were not talking about artificial intelligence the way we are talking about it today. What will drive the markets in the future stands to reason. It's things we're not considering yet. And, we'll talk a little bit more about diversification at a deeper level, but it's fundamentally understanding that things will happen to the world that have happened historically, but it's not things that are top of mind when you turn on Bloomberg or CNBC.
Yeah. And so is it more just the humility to prepare yourself to deal with those kind of surprises when they come up? Or is it trying to suss them out before they pop up? Like, what's the approach there?
Diversification requires humility. And, some of the investment managers that lack the humility, you also see in their investment strategy, they're not properly diversified. Because if you really think you know at your core what's going to happen, that shows up in an investment strategy. And you end up taking bets on what you believe to occur. But when there's a sense of humility of the not knowing, you're willing to diversify and invest in asset classes that at times there may not seem to be a current reason to invest in them. Because what history tells us is numbers don't drive markets, not fully. It's narratives and stories. And at the drop of a hat, the narrative and the story can change. And you'll only be prepared for that if you're diversified. If you have investments, and certainly we're talking about alternative investments today in a wide variety of asset classes. If you think you know what's going to happen, there'd be no need to diversify. But what history tells us when you study investment managers is it's usually those that take big, large bets on something they believe to be true. You'll hear the stories of the individuals that are right, but they're usually not right twice. And seldom are they ever right at all. So it really goes back to the boring, unsexy term of diversification.
I see. And that's why diversification and humility are linked for you, because having the humility to say, I don't understand the market, I understand that the story can change at the drop of a hat, and that will shift the market. So I will diversify properly, even if it's an unsexy investment that may not have a real enticing reason to invest in it
Sure.
right now.
Agree 100% with the caveat that it is understanding markets. Because when you study markets and you look at things over a 10, 20, 30, 50-year time horizon, which many of my clients have, particularly if their wealth is multi generational, it's the understanding that markets shift without warning.
Mm.
And you can't time why it will take place or when it will take place, so you're prepared. People, they drive cars and they have a spare tire in the trunk. They may never need it. And when they need it, it's not expected, but they have it along with a AAA card.
Yeah.
They're prepared. But people don't often have the same thought process when it comes to their own investment portfolios, which typically is a hell of a lot more valuable than the price of their car.
So it's not that you don't understand the markets. I understand the market, which means I understand I cannot predict the market.
Mm,
So I
well said.
diversify properly.
Absolutely.
I like that. Well, talk to us a little bit about that diversification. Typically, we'd ask about risk next, but I feel like diversification is the answer to the risk strategy as well. So I want to dive into what that looks like in a portfolio. So when you have a client who wants to gear their portfolio towards asset accumulation versus income or retirement, how are you differentiating those portfolios?
Well, we always start with the goal in mind. And I spend a lot of time clarifying those goals for my clients because they come into an introductory call with me. And the goals that they state are oftentimes not their own goals. They're goals that were passed on from generation to generation. It's what their friends tell them, it's what they see in the movies, it's what they think to be the right thing. It may or may not be true to who they really are as individuals. Once we understand what we're really planning for, then the work begins. And it could be as simple as, I had a family come to me. They were about 65 years of age, and they were talking about a retirement portfolio. And conventionally, that might mean investing for income. But when we really understood what they were all about, it was about the next generation. It was about charitable planning, coupled with the fact that they had more than enough money to get through 5 retirements. So it became a discussion on investing not for a 5-year time horizon, but investing for a 30-year time horizon. Once you understand the why, the investments can fall into place. But when a portfolio does not adequately fit within what it is you want out of your life and your family and your values, that's where I find people get into trouble. And it's when you understand the why that you can persevere through challenging times in the market because you understand why you're investing. People invest, but they don't oftentimes ask themselves, why are they investing? What is the purpose? What is the point? It's when we understand that we can design an appropriate portfolio for a client.
Yeah, no, that makes a lot of sense because money is a tool to get what you want. And so if you're planning for the wrong thing, you're not using that tool uh, properly, if you will. And I
Absolutely.
like your client story because Warren Buffett's the same thing. Like he's making investment decisions on 10, 20, 30 year, a 30-year basis, even though the man probably doesn't have 30
You won't
years
be there.
left to live. I mean, given current medical technology, who knows? But chances are he does not. So, but he has more than enough money to live, and so he can plan for that kind of next generation for the impact he wants to make. So we talked about the why, and I'm curious, what is the process for really getting to that crystal clear why and separating kind of current motives from other people's impressions or society's expectations on how the portfolio should look?
It's easier than people think. You just let people talk, and the questions are the fuel to that fire. Individuals these days, they want to express themselves. They want to speak. They want to talk about their past, the present, the future. But many professionals don't give them that opportunity because their meetings, they do 70 to 75% of the talking. In my introductory meetings, and it's not just one, it's typically two to three, I let them talk. And it's creating a space and also having the communication skills, which are practiced, which are learned over many, many years of being a practitioner, to allow people to truly express themselves without fear of judgment.
I love it. So it's really just asking great questions, doing some great listening, and seeking to understand, on a real genuine level, is what it sounds like.
Yes, absolutely.
Very cool. So we talked a little bit about, where you go to get latest market trends and updates for your clients. We also talked about how humility and diversification are key for addressing the markets because you understand the markets, which means you can't predict the markets. And we've also touched on starting with why when constructing portfolios. I want to jump to alts now. When you're kind of looking at alternatives in 2024, how are you going about evaluating them and knowing when to put them in a client portfolio?
Well, I like in choosing alternative investment managers to March Madness picks. You got a lot of choices. Many will outperform, many will underperform. And of course, historical performance does not always repeat itself. But when it comes to the alternative investments, do you really understand what they're doing? How have they performed over many market cycles? Will they survive when the going gets tough? And how does it help your client accomplish their goal? I don't go into client meetings necessarily having the conclusion that they need alternative investments. But when we think about diversification, having certain types of alternative investments that are carefully selected and vetted, they can play a role. But one needs to understand that the concept of alternative investment, it may not always perform that way. We're talking about unconventional ways of investing, but unconventional ways of investing do not necessarily always lead to the investment results that you're looking for. Yes, humility, it always plays a role because, where I sit, alternative investment managers are always presenting to me, always pitching me. Um, but it goes back to, do I understand what they're doing? Do I understand why they're doing it and how they're doing it? And looking at the track record over many, many market cycles.
Yeah, investing in what you can understand and then investing in people you can trust based on A, the interactions, but then B, some track record.
Sure.
And so, what's your approach when it comes to maybe an alternative that you don't understand, but it seems not promising, but just interesting? Seems like maybe some clients might want it. Maybe a client brings it to you. Do you dive in and kind of do an extensive research process? Do you go to another person who's maybe smarter than you in the area to get some feedback? That's a third party. How do you address that, if at all?
Yes. And I think the question is if at all, because I may approach these conversations with curiosity on the basis of I might learn something. I may not invest in it, but I might learn something. At the end of the day, and I can't recall an instance where someone presented to me an investment that I really, after some effort, couldn't understand. But if I couldn't understand it, I wouldn't invest in it, and I'd be willing to sit on the sideline even if it did its job consistently. I'm okay with that. I think I share this with my clients. Part of what they're hiring me for when it comes to investment selection is my ability to say no. And I say no heck of a lot more than I say yes. But when I'm speaking with the manager and I'm asking the right questions, I'm typically able to develop a keen understanding of everything that I need to know. Um, but if there's a lack of understanding on my part, how can I expect my clients to understand it when they don't live in this world? So, red flag, strong word, perhaps, but I have to be able to understand it.
It makes perfect sense. And frankly, if you sit through a whole presentation and ask questions and you can't understand it, there's probably something under the hood that isn't too exciting or isn't too clean cut, let's say.
Sure.
Um, for sure. Well, awesome. So, what role are you really looking for alternatives to play in client portfolio? Is it more on the income side of things, or is it the accumulation, just uncorrelated returns? I've heard many things from many advisors. Just curious for you.
It would be all of the above, but also understanding what positions my clients are coming to our relationship with. I'll have clients that have extensive equity positions in the companies that they founded. Well, there's their potential growth with high risk. Do we need to complement, that high risk position with more high risk venture capital? Probably not. From an income perspective, I've had clients come to me and, they've invested in deals with their friends, with their family, and they're more about income generation. I was not involved in the selection process before hiring me. They already have these positions in their portfolio. So understanding what level of alternative investments are your clients already bringing to the table and how do you plan around it? And if there are none existing, well, then it goes back to the goal and it goes back to, is it appropriate to have some parts of the portfolio for higher risk, high reward? Is there a need for income? And then everything is looked at on a risk adjusted basis. Um, if we're shooting for income, my approach generally is I want income regardless of what's going on in the world. And there needs to be that appropriate income generation when markets are turned upside down. And that's where we need to really understand the methodology and the risk levels that the investment manager is coming in with, regardless of where the market is when we start the strategy.
Yeah, no, absolutely. And so when you're looking at an investment, say for income, and you're like, I want income when the markets are turned upside down, a lot of investments go south
Yes.
when the markets are turned upside down. And then even the uncorrelated alternative investments might have significant trouble if the market is turned fully upside down or upside down enough. And so, what are some of the questions you're asking yourself about that investment strategy to understand? And this might be too vague. We might need to mention a specific investment strategy, but what are some of the questions you ask to make sure that it'll stick through regardless of the market turn?
Well, understanding what can go wrong, any investment, there's a negative side of it. And just understanding what can go wrong and asking that question directly to the investment manager. And their transparency in that is telling because there's no investment that's perfect. And really having a keen understanding of that is of the utmost importance. Certainly, we can look at things like leverage and, if it's from a private credit perspective, what types of loans are they making to begin with, right? spending time looking at the finer details, looking through the deck, talking with the manager, looking at past performance, and just having that understanding and having a healthy skepticism. There's private credit funds looking for 25% rate of returns. I'm not saying there's anything wrong with that, but I need to understand, is this a bond replacement or an equity replacement?
Hmm.
Because chances are, if it walks like equity, it talks like equity. And you just have to have some skepticism and understanding that 25% targeted returns with quoted minimal risk probably isn't real.
Makes a lot of sense. If it sounds too good to be true, it might just not be true. So
Hmm.
that's for sure. That's for sure. So talk to us about any of the emerging alternatives that you want to learn more about in 2024 because you find them interesting or they've piqued your interest.
I'll answer the question generally. And as I've discussed, I'm not generally looking for managers looking for home runs. As an example, everyone's talking about private credit. They should be talking about private credit. It's fascinating. If you have a private credit fund looking for 10% returns, I will listen. If you're shooting for 30%, I won't. I hire fish to swim, not fly. Private credit is an alternative investment. I don't look at it as an equity replacement. We have equity for that, or venture capital. We need something that won't get turned down because of a bear market, right? So the private credit piece comes up a lot. And going back to fundamental understanding of risk and return analysis is paramount.
I love it. Well, now I want to jump kind of back to your firm, Claro Advisors, your own practice within Claro Advisors. How can people really tell you guys apart from other financial advisors?
We're young. We are young, while still having our advisors having at least a decade or two of experience. We're one of the few firms that will literally be at our client's funeral. And what that means is we're one of the few that can carry out your financial wishes and execute them for the next generation, for the kids, for the grandkids. When you're sick and executing your POA, do you have an actively engaged team that knows your family that will be here? That's what separates us at the end of the day.
No, absolutely. And that is so important, especially when you're talking with clients who are really planning for the next generation. It's like, hey, I've made my money. I'm set for the rest of my life. And I just want to make sure that my kids are taken care of and that they have somebody in their corner that they know now and will know in 20 or 30 years when they're making these same decisions that I am. And so, speaking of that, when you're working with your clients, not only is the relationship with them important, but the relationship with their kids and maybe their kids' kids are also very
Sure.
important. What is most important, though, to that ideal client advisor relationship in your head?
The advisor understanding he or she is not in the numbers business, they're in the people business. And meetings are not typically conversations about market outlook, they're about people. I seek to have the relationships where when clients are most scared, most vulnerable, confused, and unsure, they call you. And that's a process of developing a deep, trusting, open relationship because it's in those moments that clients are most vulnerable to making a mistake, doing something that in time they will regret. And having us on the line to be unbiased, to be someone that thoroughly understands them and can be a voice of rationality when nothing in their life seems to be rational at the moment is one of the most important roles and privileges of being a financial advisor.
I think that's well said. And I really do think you hit the nail on the head. It's trust, it's relationships, and that's what matters because money is only a tool, again, to get to where you want to be. And at the end of the day,
Absolutely.
where we want to be is with our loved ones. And so it's really cool that you can do that alongside clients. And Brandon, I do think that is all we have for you on the show today. Is there anything else you feel like we missed that you want to talk more about briefly?
Not at all, but appreciate you asking.
Of course, of course. And if people want to know more about you, where should they go to find you?
Just claroadvisors.com, plain and simple. You'll find our entire team, myself included, Brandon Fink, and always happy to have a conversation with good people.
Perfect. Well, all the ways to contact Brandon will be down in the show notes. Brandon, thank you for watching. Everybody, thank you for listening. We will see you on the next one.